In 2006, I was sitting on more cash than I'd held in decades. Our investors at Oaktree were frustrated. They watched other funds generate double-digit returns while we sat defensive. The market was soaring. Credit spreads were at historic lows. Everyone was making money. And I was being called overly cautious, even fearful. I was 60 years old at the time. I'd seen enough cycles to know what excessive optimism looked like. I'd watched the junk bond crisis of 1989, the Asian contagion of 1997, the dot-com collapse of 2000. Each time, the same pattern: prices rising beyond fundamentals, risk being ignored, and skeptics being ridiculed. But here's what made 2006 different for me personally. I was no longer a young investor with decades to recover from mistakes. I was entering the phase where preservation mattered as much as growth. That caution, that willingness to look foolish while everyone else celebrated, saved us when 2008 arrived. We deployed $11 billion into distressed opportunities while others were forced to sell. But more importantly, that experience crystallized something I'd been thinking about for years. Investing after 60 requires a fundamentally different framework than investing at 30 or 40. Not because you're less capable, but because the mathematics of time change everything. The investor who lost the most in 2008 wasn't some reckless hedge fund manager. It was a 63-year-old retiree I knew who had $1.2 million in October 2007. By March 2009, he had $480,000. The market had dropped roughly 57%, but his portfolio dropped 60% because he panicked and sold near the bottom. He needed that money to live on. He couldn't wait for recovery. He spent the next 8 years working part-time at a consulting firm because he had no choice. That man made every mistake I'm about to help you avoid. Before I continue, I need to know who I'm talking to. Drop your age and your single biggest financial concern in the comments right now. I read every comment, and understanding where you are helps me create content that actually serves you. And if you're serious about protecting and growing wealth after 60, subscribe now. This channel isn't about chasing returns or finding the next hot stock. It's about second-level thinking, the kind of analysis that's protected capital through 8 market cycles over 5 decades. The kind of thinking that kept Oaktree's investors whole when others were devastated. In the next 17 minutes, I'm going to walk you through 7 principles that matter more after 60 than at any other stage of your financial life. These aren't tips. These aren't strategies. These are fundamental truths about risk, time, and capital preservation that most people learn too late or never learn at all. But you have to stay until the end, because the 7th principle is the one that ties everything together and the one most people violate without realizing it. Let me start with what most people get wrong about investing after 60. They think it's about becoming conservative. They've been taught to shift into bonds, reduce equity exposure, and play it safe. Every financial advisor has a chart showing how your stock allocation should decline with age. 60% stocks at 60, 50% at 70, 40% at 80. But here's what 50 years of investing has taught me. The goal after 60 isn't to be conservative. The goal is to be thoughtful about risk in a way you've never had to be before. Because after 60, you face a paradox that younger investors don't. You need your money to last potentially 3 decades or more, which requires growth. But you can't afford a catastrophic loss, which requires protection. Threading that needle requires understanding principles that most people never learn. These 7 principles aren't equal in importance. They build on each other. Miss the first one, and the others won't save you. Master all 7, and you'll navigate the next 20 or 30 years with confidence that most retirees never feel. Let me show you what I mean. The foundation principle, the one without which nothing else matters, is this. After 60, sequence of returns risk becomes your primary enemy. Not market risk, not inflation, not even longevity risk. Sequence risk. Here's what most people miss. If you're 35 and the market drops 40%, you have time. You keep contributing to your 401k. You buy at lower prices. You benefit from dollar cost averaging. A bear market in your 30s or 40s can actually improve your long-term outcomes because you're accumulating assets at better prices. But if you're 65 and retired and the market drops 40% in your first year of retirement, you face a completely different reality. You're not contributing anymore, you're withdrawing. You're selling assets at depressed prices to fund your living expenses. And here's the mathematical trap. If you withdraw 4% from a portfolio that's dropped 40%, you're not withdrawing 4% of your original capital. You're withdrawing 6.7% of your remaining capital. Do that for 2 or 3 years during a prolonged bear market, and you may never recover even when markets do. Let me show you the numbers. Two investors, both retire at 65 with $1 million. Both earn an average 7% annual return over 20 years. Both withdraw $40,000 per year, adjusted for inflation. Investor A retires in 2000, right before the dot-com crash and the 2008 crisis. Investor B retires in 2009, right as the recovery begins. Same average returns, same withdrawal rate. Investor A runs out of money at age 83. Investor B still has $780,000 at age 85. The difference isn't skill, it's sequence. The order in which returns occur matters more after 60 than the average return itself. This is why the conventional advice about conservative allocation misses the point. You don't need to be conservative all the time. You need to be defensive when defensiveness matters most, and you need to be positioned to benefit when opportunities arise. At Oaktree, we call this calibrating to the cycle. In 2005 and 2006, when I was 60, we were defensive because the cycle was late. Credit was too cheap. Risk was being ignored. We looked foolish, but we were prepared. When 2008 came, we were aggressive because the cycle had turned. That's not market timing. That's cycle awareness. And after 60, cycle awareness isn't optional, it's survival. So what do you actually do? First, you assess where we are in the cycle right now. Not where we're going, I don't predict, and neither should you, but where we stand today. Are credit spreads wide or tight? Is investor sentiment euphoric or fearful? Are people ignoring risk or obsessing over it? These are observable conditions, not predictions, and after 60, you adjust your positioning based on what you observe, not what you hope. The evidence for this principle is overwhelming. Every retiree who was devastated in 2008 made the same mistake. They were positioned as if good times would continue forever. They had 70% or 80% equity exposure. They owned leveraged products. They were reaching for yield in high-risk bonds. They weren't calibrated to late-cycle conditions. And when the cycle turned, they had no defense. This principle works, but only if you understand the second one. Because sequence risk isn't just about market declines, it's about your response to market declines. Which brings me to the framework principle, the one that determines whether you make rational decisions or emotional ones. After 60, you need a written investment policy that removes emotion from decision-making, not guidelines, not rough ideas. A written document that specifies exactly what you'll do in different market conditions. This sounds bureaucratic. It sounds unnecessary. It's neither. It's the difference between surviving a crisis and being destroyed by one. Here's what happens without a written policy. Markets drop 25%. You feel anxious. You read headlines about recession. You watch your portfolio value decline. You think about your monthly expenses. You wonder if you should sell before it gets worse. You're making decisions based on fear, not analysis. And fear after 60 is particularly dangerous because the consequences of mistakes are asymmetric. A bad decision at 35 costs you years of compounding. A bad decision at 65 might cost you your retirement security. I've seen this repeatedly. In late 2008 and early 2009, I spoke with dozens of investors. The ones who survived with their portfolios intact had predetermined rules. If the market drops X%, I rebalance back to my target allocation. If volatility exceeds Y, I deploy cash reserves according to this schedule. I review my positioning quarterly, never in response to headlines. These weren't sophisticated institutional investors. These were individuals who understood that their 65-year-old self in a panic would make different decisions than their 65-year-old self in a calm, analytical state. The ones who were devastated had no framework. They made it up as they went. They sold in March 2009 because they couldn't stand watching their portfolio decline further. They missed the entire recovery. 8 years later, they were still working because they had to. Your written policy should address 5 specific scenarios. First, what you do if markets rise 20% or more in a single year. This isn't celebration time. This is risk assessment time. Second, what you do if markets decline 20% or more. This is typically opportunity time, not panic time. Third, what you do when volatility spikes above historical norms. Fourth, what you do when your portfolio drifts from target allocation by more than 5%. Fifth, What you do when you need to raise cash for living expenses during a market decline. Write these rules now while markets are calm and you're thinking clearly, because you won't think clearly when the S&P is down 30% and financial media is predicting depression. I've lived through enough crises to know the decisions you make in crisis mode are almost always wrong. The decisions you make according to pre-established principles are almost always right. But having a framework only protects you if you understand the third principle, the one about actual risk versus perceived risk. After 60, the protection principle becomes paramount. Your biggest risk isn't what you think it is. Most people over 60 worry about market crashes. They remember 2008. They fear another 50% decline. So they shift heavily into bonds or keep too much in cash. They're protecting against the wrong risk. The risk that actually destroys retirement security after 60 isn't a market crash you survive. It's the slow erosion of purchasing power you don't notice until it's too late. Let me show you the mathematics. Inflation averages 3% annually. Doesn't sound like much, but over 20 years, that 3% compounds to reduce your purchasing power by 45%. What costs $100,000 today will cost $180,000 in 20 years. If you're 65 today, you'll likely live into your mid-80s or beyond. That's 20 plus years of inflation eating away at fixed income. Now, if you're too conservative, say you hold 80% bonds and cash earning 4%, you're earning 1% after inflation. On a $1 million portfolio, that's $10,000 per year of real return. If you're withdrawing $40,000 annually for living expenses, you're depleting capital at $30,000 per year in real terms. You'll run out of money in your early 80s, even without a market crash. This is the risk nobody talks about. It's not dramatic, it doesn't make headlines, but it's killed more retirements than market crashes ever have. I've watched it happen dozens of times. People who survived 2008 by being conservative, then stayed conservative for the next 15 years. They never lost money in market terms, but they lost purchasing power every single year. And by their late 70s, they realized they couldn't afford their lifestyle anymore. The evidence is clear. Over any 20-year period since 1926, a diversified portfolio of 60% stocks and 40% bonds has never failed to preserve purchasing power while supporting a 4% withdrawal rate. Never. Through the Great Depression, through the 1970s stagflation, through 2008. The failures come from being too conservative or too aggressive, not from being balanced with cycle awareness. At Oaktree, we've always focused on downside protection, but not through avoidance of equity risk, through careful selection of assets that have asymmetric return profiles, through buying when others are fearful, through understanding that protection means having the resources to act when opportunity arrives, not hiding from all risk at all times. So, what do? You maintain enough equity exposure to generate real returns over time. For most people over 60, that means 40% to 60% stocks, depending on your specific situation and where we are in the cycle. You diversify across asset classes that respond differently to different economic conditions. You hold some inflation-protected securities. And you rebalance systematically, which forces you to sell what's become expensive and buy what's become cheap. This brings me to the fourth principle, the one about growth in the context of limited time. After 60, you need your portfolio to compound, but you can't afford to chase returns. Here's the trap. You're 65. You have $800,000. You run the numbers and realize you need more to retire comfortably. So, you start reaching. You buy high-yield bonds from shaky companies. You invest in complex structured products you don't fully understand. You chase last year's hot sectors. You're trying to make up for lost time, and you're taking risks that could destroy what you've built. I see this constantly. People who were appropriately cautious their entire working lives suddenly become aggressive in their 60s because they feel behind. It's backwards. The time to take calculated risks is when you have time to recover. After 60, the calculus changes. You need growth, yes, but you need sustainable, reliable growth, not lottery tickets. The data on this is shocking. Studies of investor returns show that people over 60 who chase performance underperform appropriate benchmarks by an average of 2% to 3% annually. That's not because they're less intelligent. It's because they're making decisions driven by urgency rather than analysis. They're violating the principle that's guided my entire career. You make money by buying things for less than they're worth, not by predicting what will go up. After 60, your growth should come from three sources. First, from owning quality companies with sustainable competitive advantages that compound value over time. Not exciting, not sexy, but reliable. Second, from opportunistic deployment when markets dislocate and good assets become cheap. This is why you maintain some dry powder. Third, from systematic rebalancing that forces you to harvest gains from what's appreciated and redeploy into what's declined. What you don't do is chase. You don't buy the hottest tech stock because it's up 200%. You don't invest in crypto because you're afraid of missing out. You don't reach for yield in junk bonds because you need income. Every one of those strategies has destroyed wealth for people over 60. Every single one. At Oaktree, we've never chased. In the late 1990s, we didn't buy dot-com stocks even though we looked foolish. In 2006, we didn't reach for yield in subprime mortgages even though spreads were tight. We waited. We stayed patient. We deployed capital when opportunities met our standards, not when we felt pressure to act. That discipline matters at any age, but after 60, it's non-negotiable. This connects directly to the fifth principle, the optimization principle. After 60, tax efficiency becomes a force multiplier for wealth preservation. Most people think about taxes as something their accountant handles once a year. But after 60, when you're likely drawing down assets to fund retirement, the order in which you withdraw from different account types can add or subtract years from how long your money lasts. This isn't about exotic strategies. This is about basic sequencing that most people get wrong. Here's what I mean. You have three buckets: taxable accounts, tax-deferred accounts like traditional IRAs, and tax-free accounts like Roth IRAs. Most people withdraw proportionally from all three. That's almost always wrong. The optimal sequence depends on your tax bracket, your required minimum distributions, your Social Security timing, and your estate planning goals. Generally, you want to draw from taxable accounts first because those have the most favorable tax treatment on long-term capital gains. You want to delay tax-deferred withdrawals as long as possible to maximize tax-deferred compounding, but not so long that required minimum distributions push you into a higher bracket. You want to preserve Roth assets longest because they grow tax-free and have no required distributions. But here's where it gets interesting. Sometimes you want to accelerate tax-deferred withdrawals in your 60s if you're in a low bracket to avoid massive distributions in your 70s when Social Security and RMDs push you higher. Sometimes you want to do Roth conversions during market declines when the tax cost is lower. These decisions can add hundreds of thousands of dollars to lifetime wealth. The evidence is clear. Studies show that optimal withdrawal sequencing can extend portfolio longevity by 3 to 7 years compared to proportional withdrawals. That's not a small difference. That's the difference between running out of money at 82 versus 89. That's the difference between comfort and crisis. I'm not suggesting you become a tax expert. I'm suggesting you work with someone who understands these strategies and implements them systematically, because after 60, every dollar you save in unnecessary taxes is a dollar that compounds for your benefit. And compounding matters even when your time horizon is measured in decades rather than half centuries. Now we come to the sixth principle, the one that most people resist because it requires admitting limitations. After 60, you need to simplify your portfolio and your decision-making process. Here's what happens to many investors as they age. They've accumulated positions over decades. They have stocks from old employee plans. They have bonds from different periods. They have mutual funds they bought years ago. They have accounts at multiple brokerages. Their portfolio is a museum of past decisions, and it's become too complex to manage effectively. Complexity is the enemy of good decision-making at any age, but especially after 60. Every additional position requires monitoring. Every additional account requires administration. Every additional decision point creates opportunity for error. And the research shows that cognitive decline, even mild decline, affects financial decision-making earlier and more significantly than most people realize. This isn't about intelligence. I'm 79 years old. I'm as sharp as I've ever been on investment principles. But I'm also self-aware enough to know that I'm not as quick with complex calculations as I was at 50. I'm not as patient with tedious details. And I've structured my approach accordingly. I focus on principles, not minutiae. I rely on frameworks, not constant recalculation. I've simplified where simplification makes sense. The data supports this. Studies show that portfolio performance doesn't improve with complexity beyond a fairly low threshold. 30 individual stocks don't outperform 15 if chosen with the same criteria. 7 mutual funds don't outperform 4 if properly diversified. Multiple brokerage accounts don't add value, they add confusion. After 60, you should be able to explain your entire investment strategy in 5 minutes. If you can't, it's too complex. You should be able to review your portfolio quarterly in under an hour. If you can't, you own too many positions. You should be able to rebalance annually without agonizing over dozens of decisions. If you can't, you need to consolidate. This doesn't mean dumbing down your approach. It means focusing on what matters. At Oaktree, we invest in distressed debt, which is complex. But our decision framework is simple. Buy good companies in temporary distress for less than intrinsic value. Hold until value is realized. That simplicity allows us to execute consistently without getting lost in complexity. For you, simplicity might mean owning 4 or 5 broadly diversified low-cost index funds instead of 30 individual stocks. It might mean consolidating 3 IRA accounts into one. It might mean selling positions you don't fully understand. Each simplification reduces cognitive load and improves decision quality. This brings me to the 7th and final principle, the one that ties everything together. After 60, your most valuable asset isn't your portfolio. It's your decision-making framework in the face of uncertainty. Everything I've told you, sequence risk, written policies, protection against real risk, sustainable growth, tax efficiency, simplification, all of it rests on this foundation. You must acknowledge what you cannot know while acting decisively on what you can assess. I don't know where markets are going next year. I don't know if we'll have a recession. I don't know which stocks will outperform. After 50 years in this business, after building Oaktree into one of the most successful investment firms in history, I still don't know these things. And neither does anyone else, regardless of what they claim. But here's what I do know. I know where we are in the cycle right now based on observable conditions. I know what my principles tell me to do based on those conditions. I know that maintaining discipline through uncertainty has worked for 5 decades. I know that panicking has never worked. I know that chasing performance has never worked. I know that ignoring risk has never worked. This is second-level thinking. First-level thinking says, the market might crash, so I should sell everything. Second-level thinking says, the market might crash, but I don't know when, and I need long-term growth, so I should maintain appropriate equity exposure while being positioned defensively if we're late in the cycle. First-level thinking says, I need more money, so I should take more risk. Second-level thinking says, I need sustainable returns, so I should buy quality assets when they're reasonably priced and avoid reaching for yield in junk. This framework, acting on what you can assess while acknowledging what you cannot know, is what protected Oaktree's investors in 2008. It's what allowed us to deploy capital when others were paralyzed. It's what's guided every successful long-term investor I've known. And after 60, it becomes more important than ever because you don't have time for multiple cycles of trial and error. You need to get it right, or at least avoid getting it catastrophically wrong. And the only way to do that consistently is through principles, not predictions. So here's your framework going forward. Before every investment decision, ask yourself 5 questions. First, am I acting on analysis or emotion? Second, what could go wrong, and can I survive if it does? Third, does this fit my written policy, or am I making an exception? Fourth, am I reaching for returns I don't need or accepting risk I can't afford? Fifth, will I understand this decision in 5 years, or will I wonder what I was thinking? If you can't answer those questions satisfactorily, don't proceed. Wait, think more, consult your policy, because after 60, the cost of a major mistake isn't just financial, it's the peace of mind that comes from knowing you'll be secure for the rest of your life. I started by telling you about 2006 when I sat on cash while others celebrated. That decision looked wrong for 2 years. It looked brilliant in 2009. But the real lesson isn't about being right. It's about having principles that guide you through uncertainty. That's what kept me positioned correctly. That's what allowed Oaktree to capitalize on crisis. That's what these 7 principles will do for you. You're over 60. You've spent decades building wealth. The question now isn't whether you can get rich. The question is whether you can stay rich while maintaining the lifestyle you've earned. These principles, understanding sequence risk, following a written policy, protecting against real risk, generating sustainable growth, optimizing taxes, simplifying complexity, and acting on what you can assess, these are what separate successful retirement from desperate scrambling. Most people will read this and change nothing. They'll keep making emotional decisions. They'll keep chasing performance. They'll keep ignoring the principles that matter. Don't be most people. Drop a comment right now telling me which of these 7 principles you're implementing first. Public commitment increases follow-through. Use it, and subscribe if you haven't already. Because this is about more than money, it's about the intellectual framework that allows you to navigate uncertainty with confidence. That's what 50 years of investing teaches you. That's what surviving 8 market cycles shows you. That's what building Oaktree Capital proves. These 7 principles work, but only if you implement them with discipline and maintain them through uncertainty. I can't do that for you. I can only show you how. The rest is up to you.